Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, April the 20th, and just going to take a brief moment to update you on markets and what they did last week. It was a positive week in equity markets as markets continue to march higher. The S&P 500 was up 79 basis points or 0.79% on the week. The mid-cap index outperformed, up 1.73% on the week, and the small caps did better than large caps as well, up 1.10% as measured by the S&P 600. So a great week for small and mid-cap as they continue their recovery. But what I want to talk about this week is, I don't know about you, but going back all the way to June of 2021, I have been hearing from Wall Street economic analysts that we are 18 months away from a recession. And that is the call that I heard again this week, and that we heard from several economic chief economists or Wall Street analysts or economists that are predicting the economic future for the U.S. are predicting now, not this year we have the recession, but again, it's 18 months from now. You remember heading into this year, everyone was talking about the recession that the proverbial recession that we were gonna hit in 2023. And so one of the things that we wanted to talk about is what we believe at River Place is we're in what's called more of a rolling recession, and what investors and what people are fearing is 2008, 2009 again. But we really, going back to last year, we had two negative quarters of GDP consecutively in the first and second quarter of last year. While employment remained very, very strong, we believe that was the start of an inventory correction. And a rolling recession is a recession that doesn't hit every sector all at once, like you saw in 2008, where everything slowed down all at one time. You're seeing it roll through sector by sector. So it started with the warnings last year from Target and Walmart that they ordered too many goods, and that they were sitting on too many goods, and that inventories were too high. That's a negative drag on GDP. But you've also seen just things roll over in shipping. You've seen the cost of shipping go from 20,000 down to under 10,000. Trucking has gone down tremendously as well. You've seen impacts in trucking. You've seen information technology really pull back with a tremendous amount of layoffs and employment cuts in Silicon Valley, as well as expense management. These are all contractionary items. They're not growth items for the economy. But we do have some very strong fundamentals that are still holding this economy up, whether it's the Inflation Reduction Act spending that is going to hit the economy, whether it's the CHIPS Act or whether it's the infrastructure bill. There's some government spending that's going to keep a portion of this economy trugging along. So all eyes this week are on some of the Fed minutes and the Fed data that we got this week from the Beige Book, and what we've seen is what we've heard, and what we believe is going to happen is that we're going to get another 25 basis point hike by the federal bank in May, and that they'll pause there to see what the overall inflation is doing. Inflation has been coming down every month since the highs of June of last year. So we continue to see it come down, but it's not logical to think that it's going to come from 9% to 2% in 2 months. Inflation does not fall that quickly and does not fall that way. But one of the things that we have been talking about is the deflationary aspect of what is happening with the banks. And we got that data for the last 2 weeks of March that banks pulled back their lending to levels that we haven't seen before, where they were being very constrictive on what they're going to lend out. That is going to slow down economic activity. When you are not lending out for CapEx and different expenditures, that slows down economic growth. So we do believe that we're in for a slowdown. But interestingly enough, to tie all of this together, CNBC did an overall pessimism survey. They polled 1,000 people, and 69% had a negative view of the economy moving forward. And only 24% thought it was a good time to invest. Well, I will tell you, I'm going to be contrary to that. And I'm going to say I think this is a great time to invest for two reasons. One, the market is a forward-looking vehicle. The market is going to price in an economic recovery before it even happens and before the recovery's even started. Think back to 2009 when the market was up 26% that year. So think about that. The market's going to price in the eventual recovery and the outcome of coming out of any type of recessionary environment ahead of time. The second thing is the recession's been priced into the equity markets. We hit lows back in October that we don't believe we're going to revisit because the investors know we're going through what is called a rolling recession. And you'll see the market move very, very quickly here until the retail investor gets back in the market. You're going to see violent moves between growth and value intraday, between different sectors intraday. It's all going to be led by algorithmic trading. But once the retail investor gets that pessimism turned around, that's the time that you'll see markets really take off. But it's always important to get in early before everyone else is, and that's the key here, is when the right time to get into the market. I'm not going to call a bottom. I can't call a bottom. Anyone who says that they can call the true bottom, I just disagree with. But what we see is strong money flows in a stock market that's very resilient and continuing to move upwards, and we would hate for people to sit out on the sidelines out of fear. So if you have questions about what's going on in your individual portfolio or ways that which we can help you, feel free to give us a call. We'd love to talk to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a great rest of your week, everyone. Thank you so much.